the question I have is, I've got this asset allocation, and when I need to start drawing down, I go around in circles. Obviously, I would think logically you would pick any category that is above the percentage that is recommended, and then the stock that's positive. All of that makes perfect sense. But as I start to draw this down, it's going to totally mess up the asset allocation because I will not be putting any more money in. Then the final part of the question is to sell part of a position, sell the whole position. It just seems rather confusing. Building it wasn't so hard. How do you use it?
Okay, that's a great question. Well, you use it kind of in the same, or you do it in the same way that you built it. Use your portfolio tracker. So when you use your portfolio tracker, when you have a built out portfolio, just naturally your sectors are going to get out of balance simply because different investments do better under different market conditions. You have some pieces of your portfolio that are designed just to generate some interest and not really grow. You have other parts that are, conservative growth, and then you have maybe some other parts that are really aggressive growth. So just depending on what's doing well during the business cycle, your portfolio is going to get out of balance. So when you get to the point where you are starting to draw down from your IRA, now when you get to a certain age, you have to take money out. But just because you have to take it out doesn't mean that you have to spend it. So then there's a question of, are you taking the money out because you're supplementing your income, or are you taking money out because you have to? Well, if you're just taking money out because you have to, if you have a perfectly balanced portfolio inside your IRA and you have to move money out, you can do what's called an in-kind distribution, where you just pick certain shares of stock or a security and move it from your IRA into, let's just say, a regular investment account. Now, you have to pay taxes on that distribution, but you can still keep the investment. When you're putting everything on your portfolio tracker, I recommend that you use everything that's in any investment account that you have, whether it's an IRA, a Roth, or just a regular investment account that is used for the same purpose. So all of your retirement portfolio assets should be listed on that portfolio tracker, and you should be using one model to do all of that. So if you were doing that before you had to take the distribution, it's probably not going to change much once you move it to a different account. So you'll just lose a little bit of your cash because you've got to pay the taxes on that. So it probably shouldn't really mess up your asset allocation too much. If you are using the distributions to supplement your income, then what you can do is you can try to time that with a rebalance. So again, you're going back to your portfolio tracker. You're going to see the sectors that you're overweighted in. If you're drawing down, the money every month is really coming from out of your cash. So that cash has to be replenished from time to time. And that's just naturally going to create a deficit or an underweight in your cash, and it's going to create an overweight in another sector. So that's where you're going to look to start to take money out of investments. That's how you're going to choose the investments that it needs to come out of. And again, I don't know how people do it if they're not using that tracker. It is really easy to use.